to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Andrew Cartwright, investment manager based out of our Birmingham office. And this week, I'm delighted to be joined by regular commentator and head of fixed interest research, Richard Carter, and head of the Quilter Cheviot Managed Portfolio Service, Simon Doherty. Welcome, Richard and Simon. And Richard, just starting with you first. Although last week was relatively quiet in terms of major data releases, we've still seen the situation around the Iran continue to move back and forward. And at times, there's been suggestions of a path towards resolution, and at others, it just seems to have escalated again. Could you bring us up to speed on how that situation has evolved over the past week? Does this stop-start pattern increase the risk of markets mispricing the situation? And to what extent is that the market reaction we're seeing really been driven through oil prices and in turn expectations for inflation and interest rates?
Yeah, Andy. I mean, I think as you say, it's been a huge amount of back and forth in negotiations between US and Iran, and at moments it's looked like it's all going to fall to pieces, and there have been sort of various exchanges of fire. But I guess the good news is that despite sort of ample opportunities for Trump to say, right, that's it, we're giving up on negotiations, we're going back to bombing, he has really tried not to do that, even to the extent of trying to rein in the Israelis in Lebanon. So I think they do want a deal, but it's just maybe going to take some time to get across the line. I think that the risk is, of course, even if they do sign something, that markets might be a bit skeptical about how long sort of peace in the Middle East is really going to last for. But as long as you get the Straits of Hormuz open, that would be a good start, I think. I mean, in terms of what you asked about market reactions, I mean, there's always a risk that the market's complacent on this, but as we say, Trump does seem keen on a deal. The mechanism definitely is what's really happening with the oil price, and the longer this goes on, the more you start to worry about not just a sort of transitory bump in inflation, but something more prolonged that we've seen in the past during COVID in Ukraine, when you start to get sort of second round effects, and that would be a worry, not just for bond markets but for equities as well, and that's when you would start to think about interest rates going up, not just maybe in Europe but also in the US and UK potentially, but hopefully there'll be a peace deal before we get to that stage.
And just turning our attention to this week, Richard, and you sort of touched upon sort of interest rates in Europe. And one notable report that is due out is the preliminary EU inflation figures for May. What are you watching out for within that release? And how might the ECB respond if we see any surprises in either direction? And are there any other macro reports on your radar that could indicate a key risk or act as a short-term catalyst for markets, aside from perhaps the obvious resolution to the Iran conflict?
Yeah, I mean, obviously, Trump comments from Trump will be the usual sort of focus for a lot of people. I mean, I think with the Eurozone, we've seen some of the inflation prints from some of the individual countries, and inflation is building to some extent, although we're still at sort of fairly low 2% plus numbers in most areas. So it's not too dramatic. I think the bigger thing with the ECB is the comments from some of the officials recently have been pretty hawkish and saying they are worried about second round effects. You also got to remember, rates in Europe down at 2% are quite a bit lower than they are in the US and UK. So maybe there's some, they're in a different starting place. So maybe they feel the need to raise rates perhaps earlier than some of the other central banks do. So it does look like that's going to happen. The next ECB meeting is next week. The other thing really going on this week is non-farm payrolls in the US. That's obviously always an important number, but I don't think the Fed, whether the number's weak or strong, will be making any adjustments to interest rates this month, but it might come later.
Thank you, Richard. And I'm also delighted to welcome back fellow regular podcast host Simon Doherty, and this time in his capacity as head of the Managed Portfolio Service here at Quilter Cheviot. And Simon, the Managed Portfolio Service has continued to evolve and go from strength to strength. And one of its key differentiators is the active investment management approach within the building block structure. both in terms of tactical asset allocation and underlying fund and direct stock selection, rather than say a sort of more static fund of funds or purely passive index approach that many other managed portfolio solutions rely on. So whilst last week may have been somewhat quieter, we've certainly had a very eventful few months with global financial markets continuing to test the balance between growth, resilience, and the interest rate outlook. Simon, could you talk us through what's been happening within the managed portfolio strategies recently, and in particular the thinking behind the rebalancing that we saw in mid-May? How has that flexibility helped you respond to the recent environment? And to what extent was that driven by top-down asset allocation versus underlying fund and stock level decisions?
Well, thanks very much, Andy. And yes, eventful is certainly one way to describe 2026 thus far. It's important to remember as well, though, that it's been a positive environment for investors who have managed to navigate that periodic bouts of turmoil that we've seen. And May obviously was another positive month for equity markets. That followed on the heels of what was a very strong April. We've seen the US and emerging market equities lead the way in terms of that strong recovery seen since March's lows. And if I try and frame what we've been doing within the MPS strategies over the course of the year so far, financial markets have essentially been in that tug of war for much of 2026 between geopolitical concerns, so most recently and most notably, of course, the Iran conflict. But let's not forget events, early in the year as well, uncertainty around the situation in Venezuela, the dispute over the future of Greenland. And obviously, as Richard has highlighted as well, we've had the ensuing inflationary worries, which have led to some concern amongst investors. On the other side of the rope, you've had supportive economic data, you've had very strong earnings updates, and obviously the prominence of the continued AI investment theme. And against that backdrop, we've seen equity markets demonstrate some exceptional resilience in the face of these challenges. And I think we're at a point now where, there is that expectation that there will be an imminent US-Iran deal, a deal that leads to a more sustained peace and the free passage of shipping through the Strait of Hormuz. That's further bolstered sentiment, albeit, the situation does remain fluid. So that's the context. You're absolutely right to highlight that most of what we do now in terms of activity within the MPS strategies takes place on an ongoing basis under the bonnet of what we call the building blocks. So the funds used within our MPS strategies that enable us to reflect that output you cited from our investment process, the capabilities of our direct equity and our fund research teams. And given that fluid backdrop, we have been particularly active in 2026. And for instance, and just a flavour of what's been going on, we've been adding to mining companies in the UK. We like the materials sector. We've been adding to energy stocks as a hedge against the prospect of a prolonged elevated period of geopolitical uncertainty. But we've also been adding to technology names that we see as well placed to benefit from, the hyperscaler AI capex story, or, in simple terms, the money that big tech firms are spending on infrastructure, data centers, AI computing power, et cetera, et cetera. So there's been plenty of opportunities to take advantage of that structure. There have also been stock-specific opportunities arising, be it a strong corporate recovery strategy that we've identified, or, an attractive position in a growing end consumer market that we think merits a position within the portfolio. So rebalancing, as you mentioned, that we undertook in May is now really just a headline adjustment in our allocations to different asset classes or regional markets. Stock or fund specific changes are implemented under the bonnet of the building block funds themselves. And if we look at 2026, we've undertaken two of those rebalancing exercises. The first was in January. We reduced the UK, the European, and the emerging markets equity exposure of the strategies, and we added to US equities. And we did that off the back of a period of what was and had been relative underperformance by the US market. But as mentioned, since March, that has really turned around. Another change that we've implemented this year has been a reduction to the headline allocations to fixed interest markets. In May, that was the other core takeaway from the activity. So a further reduction in the bond allocation. We use the proceeds there to add to hedge and absolute return exposures across the MPS portfolios. And that was really done on the back of a couple of views, really. So firstly, what is a less supportive outlook for interest rates this year from where we were at the beginning of 2026? In the UK, you have, the ongoing domestic political turmoil, albeit markets have certainly stabilised, and we saw, improved performance over the course of May with, some more supportive inflation data as well. We've also seen increased correlations between bonds and equities. So the move was really designed to try and ensure that we are bringing some further diversification into portfolios through some of these strategies. And we are seeing opportunities presenting themselves given that, tumultuous backdrop across financial markets for hedge fund managers to take advantage of price disconnects and some of the opportunities that continue to arise. So the takeaway is not that we've just turned our back on bonds full stop. Welcome Richard's views, and we discuss this very regularly, but, you are being paid just under 5% now on the 10-year UK gilt. The asset class does provide some downside protection if we see a sharp drop-off in economic activity. And equally, if inflation surprises on the downside and undershoots as well. So it's really just trying to strike that balance across portfolios and ensure that, that the bond exposure that we do hold continues to be very liquid, very high quality, but equally we're seeing opportunities across other asset classes as well.
And Simon, now you sort of mentioned sort of US technology and the AI theme a few times there, and US and Asian technology stocks have continued to dominate global market returns, and it seems sort of balancing the strength of AI-driven earnings story against elevated valuations and the increasing concentration with the indices. It feels like it's one of the sort of the key questions at the moment, and the extent to which a relatively small number of mega cap names are driving index returns does sort of raise questions around how diversified those indices really are in practice. So, Simon, just to sort of drill down into a little bit more detail, how are you thinking about the sort of current positioning across the managed portfolio strategies in this context, both in terms of where you continue to see opportunity and where you need to be mindful of that sort of concentration risk? And how does that influence the case for active positioning versus simply tracking an index at this stage of the cycle?
It's a very good question, and tech has obviously continued to dominate headlines. I think it's worth reminding listeners that there was a real wobble earlier this year prior to the Iran conflict. The market was really throwing some very skeptical glances towards the sheer spend that some of these largest tech names were signaling in their earnings updates. And on the flip side, you also had a very weak period for software stocks. So somewhat conflicting conclusions being drawn by the market. You could argue, on the one hand, too much is being spent on AI capex and the return on investment might potentially not be there. On the other side of the ledger, AI is going to disrupt all of these business models, and the prospect of some of these names going to the wall is certainly higher than it once was. So I think against those conclusions, our mantra has been there is undoubtedly a fantastic opportunity here, but selectivity is key. And selectivity both in terms of your sector or subsector allocations, but also the names that you own. So there's been a lot of comment in recent years about the so-called Magnificent Seven. We own 6 of those 7 names. We don't own any of them at a market weight. Quite the contrary, our tilts are skewed towards those names where we see a more attractive opportunity, and away from those where we, do acknowledge the quality of the business and, we want to own those names, but we'd prefer to deploy that additional capital elsewhere. And for what it's worth, Tesla is the one name that we don't own out of those so-called Mag 7. We see the valuation as being overly stretched there. But equally, it's not just about those names. We see some excellent opportunities across, other segments. of the tech sector, both in the US, but also across Asia and emerging markets as well. One comment that Ben, our tech analyst and head of technology research, often says is, seeking to identify growth opportunities at a reasonable price, not at any price. So, again, that is something that we're very mindful of, not wanting to pay in terms of over the odds multiples to purchase companies that might well have a fantastic growth trajectory, but that is more than priced in. So in terms of where we are, selectivity at the individual name level, we currently have a tilt towards semiconductor stocks versus software. We think there are some tremendous opportunities in that space. Equally, some of the pessimism around several of the software stocks, not just in the US, but the UK and Europe as well, we believe to be overdone. So we continue to own a number of those as well. But it's just about attempting to, chart a course through what is a very fluid situation, but one which undoubtedly has benefited investors by being exposed to it. And we continue to look at all of those, worries that continue to emerge about, possible bubble conditions. We don't see that in the names that we own, and we see very sound business models. But as you said, Andy, the benefit of an active approach is the ability to, pivot and change course should we feel that the risks outweigh the opportunities at any time.
Thank you very much, Simon. And of course, next week, or just in just over a week's time, we have the World Cup starting. So I've just got one final question, and perhaps the most important question of today, and to Richard and Simon, and that's your predictions as to who's going to win the World Cup. And Richard, perhaps we could start off with you. Who's your money on?
Normally, a competition in the Americas, Andy, you go with a South American team, because most times, apart from when Germany won in Brazil, most times it's either sort of Uruguay, Argentina or Brazil. But I don't think they've got the quality of the squad. So, I think quite a few teams have got weaknesses, and I think the conditions are going to be difficult. But I'm going to go with a sentimental choice and go for England this time, because I think the fact that they can leave out such players like Cole Palmer and Phil Foden just shows what strength we've got. So very unusual for me to predict England, but I'm going to go for them this time.
Okay, and Simon, who do you think is going to win?
I'll second that. Yeah, I'll go down with the ship alongside Richard, and we'll have a good time while doing it. But I think it's really positive to see just how strong the English teams were in European competition this year. Got some of the squad, in fantastic form, and having a real taste of success in recent months. So yeah, I'll be the diehard supporter as well, and back the home team.
That's great. Well, thank you very much, Simon and Richard. One for your great insights today, and also your top punditry predictions for the World Cup. So did you enjoy our discussions on the podcast today? If so, we'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials, and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. So we'll be back next week. And in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on the current conflict and other market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you again to Richard and Simon, and to you all for your time today. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.